Hi, welcome to this quick Screencastify broadcast where I'll be looking at the basic introduction to double entry bookkeeping. Okay, the first thing that we need to know is a really quick example to something or quick introduction to DEDCLIC. DEDCLIC stands for debit, expenses, assets and drawings, and credit, liabilities, income and capital. Okay, we'll go through in a minute what we mean by expenses, assets and drawings, liabilities, income and capital. The important thing to know is that debit entries always go on the left-hand side of an account and credit entries always go on the right-hand side. Right, the account itself, commonly or often called a T account. Officially, they're actually ledger accounts because they're stored in something called a ledger. Okay, and what they will have on them, or what you should always record on them, are the dates. You should always have a column for the financial amount. In this case, I'm using dollars. Okay, but it could be pounds, Kuwaiti dinar, any currency that you're using. And there's also a column in there for notes. And what we normally put in the note column is the opposite account in which the other entry has occurred. And one of the important things to remember about accounting is we would always have two entries for every transaction. There will always be one account which is debited, and there will always be one account which is credited. Okay, this is sometimes called the duality concept, but it's important to remember that for every single transaction you do, you need to make sure you've done a debit and a credit entry. In this case here, we're just going to look very quickly at how to fill in a ledger account. So in this case, imagine that we've purchased a motor vehicle for $3,000. Things that we need to remember every time we do an entry, there needs to be a date. I'm just randomly going to pick the 1st of January 2015. Okay, and in an exam or a question, you'll be told the date. The note is normally the opposite account where the opposite entry occurs. And in this case, because we're buying a motor vehicle and we're going to use cash of $3,000, the opposite entry will appear in an account called cash. And then we put the $3,000 in the third column. And it's important that we keep the columns there, because at times when we move on through the course, you're going to need to start adding up all the debit and credit entries. And if you end up not keeping them nicely in columns, then you're going to start having problems identifying where your money is. Okay, example of a credit entry, very, very similar. We've made a sale and we've sold $2,000 worth of goods to a customer, and the customer's paid us by check. So if they're paying us by check, the money is going to go straight into the bank. Okay, so put the date in. Again, very important. You will lose marks in an exam if you don't put the dates in. And then because we're getting paid by check, the opposite entry will go in the bank. And finally, we'll put the $2,000 in, and that's an example of completing both a debit and a credit entry in a ledger account complete. Right, assets. They're resources owned by a company. For example, a machine might be a motor vehicle. Expenses, that's the cost of running a business or a company. And drawings, that's any money that the owner takes out for their own use and not the business use. Give me some examples that you can go over once you finish listening of common assets. Okay, it's important that you learn these. Fixtures and fittings, what we would do very often, or what businesses always do, they wouldn't have a separate account for shelves, one for desks, one for tables. They group them together, and the term they use is fixtures and fittings. Machines owned by business normally get grouped together, and you'll often see the account called plant and machinery, or plant and equipment, or plant and machinery, or just machinery. Motor vehicles, property, land. Quite often you'll see land and buildings grouped together. Okay, the things that normally go on the credit side, we've got liabilities, that's money owed by business. Income. Income's an economic benefit from the sale of goods or services. It's not always cash. So a lot of businesses' sales are done on credit, and therefore the cash might flow in a little bit later than when the actual sale occurs. You've got capital. Okay, that's investment of the owner in a business. And just looking down the examples of liabilities, a couple there that may need some explanation. Mortgage, that's really a kind of loan, but it's normally got a building or possibly land attached to it. You've got an overdraft. Normally in our bank accounts, we've got a positive amount of money. So when I get paid, my money goes into my bank account and I have an asset. Occasionally, what may happen, I might spend more money in a month than I've actually been paid, and banks normally allow you to have a negative amount of money in your bank account, and that's called an overdraft because we now owe the bank money. And trade payables, they're people that we've bought things off, but we haven't yet paid them. We bought them on credit, and therefore we owe them the money. And the opposite, when we sell things to people on credit rather than for cash, we call those trade receivables, and I've written a definition of that on the previous page of the spreadsheet. And then finally, you've got a couple, some examples of incomes that a business might receive. Main one is sales, and that might be either sales of goods or services. Services are when we do things for people rather than giving them goods. So, for example, a hairdresser, they sell a service. Builder may will sell both a service, but he may also sell the bricks that he then uses to make the house. Okay, so how do we complete a transaction? I've got 3 examples here that I'm going to go through with you, and then you've got 2 pages of examples that you're going to try and do. Okay, on the first one, we're going to pay $80 of interest to the bank. So what I've set up here, I've set up one ledger account called loan interest, and the other ledger account is the bank. Loan interest is going to be an expense to the business, it's going to cost us money. So what we need to do is to put in a date, and I'm just randomly going to carry on picking the 1st of January 2015. You obviously in the question will be told the dates that you need to select. I'll put bank in the note because that tells me that the opposite account is the bank account, and for the later date I need to go through and check I've done this transaction correctly. When I find it in the loan interest account, I know that I need to go and look in the bank account and put the quantity in the 3rd column. In the bank account, a little bit strange because bank is normally an asset, but I'm losing an asset, so I need to credit it. When I gain money in the bank, that's a debit entry. So credit because we're losing an asset. Okay, and that's loan interest is the opposite account, so that in, and remember to put the money in the 3rd column, which is $80, and that's the first example complete. Second example, we're going to buy a new factory building, and we're using a bank check. So the 2 accounts that are going to be affected is I've called my big account buildings, and I'm going to put a debit entry in the buildings account. I need to put a debit entry in because I'm gaining an asset in the buildings account. So again, 1st of January 2015, and the opposite ledger account will be bank, because I paid by check. In the third column, put in the 10,000 and then go down to the bank T account or ledger account, record the date. In the note, put in the opposite account in which the debit entries occurred, and that's buildings. Okay, and it's 10,000. Final example, I'm going to purchase another building. However, this building I'm going to buy with a mortgage. So that's a form of loan. So again, the building account, we should all be able to do this by now, but this is going to be increasing an asset. The opposite account is a mortgage account, put that in the third column, second column, and then in the third column, write the amount of the transaction, 50,000 US dollars. Mortgage, quite straightforward this one because it's a liability, it's a form of loan, so we just follow the normal straightforward dead click rules. I'm increasing a liability, so put the date in, put the opposite account, buildings, and put the 50,000, which is a transaction amount in, and we've got both a debit and a credit entry. Right, it's time for you to have a go at doing some work yourselves. We've got a couple of pages of examples with the answers as well on the next page. On the first one, I've actually given you the names of the T accounts. So for the first example, you need to decide whether it's a debit or credit cash, and you need to decide whether you're going to debit or credit the sales T account when we sell goods for $350. On the second set of examples, slightly more difficult because you're going to need to decide what you're going to call both the T account for the examples. But what you have got, so once you've done it, you can be able to go and check that you've done the right thing. Okay, I've given you the answers as well to the questions. Right, good luck with doing the examples. Any questions, please obviously contact me and I'll do my best to answer. And I hope you enjoyed that quick introduction to double entry and using dead click.